call, hosted by JM Financials. As a reminder, all participant line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumanyu Saraf from JM Financial. Thank you, and over to you, sir.
Thank you. Good afternoon to all the participants. We are pleased to host the earnings call of Gopal Limited for Q2FY25. From the management, we have with us Mr. Raj Hadwani, CEO, Mr. Mukesh Shah, CFO, Mr. Naveen Gupta, Chief Business Officer. I will now hand over the call to the management for opening remarks, post which we will follow up with the Q&A. Thank you, and over to the management.
Good afternoon, everyone. My name is Raj Hadwani. Thank you for joining us for the earnings call. We hope you all got a chance to go through our investor presentation uploaded on the stock exchange. I will share our key operational highlights for the quarter and half year ended 30 September 2024. I am pleased to report that during the second quarter of FY25, we delivered strong performance in line with our guidance. Our top line grew by 13% year-on-year, reflecting our ability to drive sustainable growth through strategic initiatives. This growth was primarily driven by our enhanced market position, which focused on the expansion of our distribution network, innovative product portfolio, and strengthened brand visibility. Looking at the segment performance, our focus on increasing the contribution of gatia and wafers to the revenue mix in both the core and focus market yielded positive results. The gatia segment grew by 13% year-on-year, while wafer witnessed a substantial increase of 47% in Q2 FY25. Speaking of H1, gatia has shown growth of 12% and wafers 49%. Talking about state-wise performance, our core market showed growth of 6% year-on-year in Q2 and 4% in H1 FY25. Our focus market continued its growth momentum with revenue growth of 29% YOY in Q2 and 32% in H1 FY25. This was largely a result of our ongoing efforts to expand our distribution network within these regions. During the year, we have added 150 dealers in the focus market. We also expanding our footprint in other states where we are well accepted and witnessed stellar growth. During the quarter, we also launched a marketing campaign for Crystal's brand, reaffirming our commitment to expanding our product offering and strengthening market penetration. As we look ahead, we plan to introduce additional branding and marketing initiatives in the upcoming quarters to increase our brand visibility. In recognition of our strong financial performance, I am pleased to announce that Board has approved the first interim dividend of ₹1 per share, that is 100% on the face value of ₹1 for financial year 24-25. This reflects our commitment to delivering value to shareholders while maintaining our focus on sustainable growth and profitability. One of the key drivers of our success continues to be the robust distribution network. We have expanded our distribution network to 828 distributors, an increase of 161 distributors in the past 6 months. This growth has been instrumental in driving our revenue and increasing our market share across any region. From a manufacturing standpoint, our total production capacity now stands 4 lakh 10,154 metric tons, which provides us ample headroom for growth. Our current capacity utilization is at 35 to 40%, which ensures that we are well positioned to scale operation in upcoming 2 to 3 years without significant additional investment. We are confident in the strength of our strategy, which is centered on expanding our market presence, enhancing operational efficiencies, and fostering innovation across our product lines. We are well positioned to capitalize on future opportunities and drive continued success in the quarter ahead. I will now request Mr. Mukesh to provide his thoughts on quarter gone by.
So thank you, Rajbhai. Good afternoon, everyone. Let me take you through the financial highlights for this quarter and the half year ended 30th September. So I'll start with revenue first. During Q2 of this year, we have achieved a revenue from operations of close to 403 crores, which marks a year-on-year growth of 13% and quarter-on-quarter growth of 14%, which is in line with our guidance, which we have been giving in our earning calls in a couple of calls. Coming to margin, our gross profit reported at 117 crores, which reflects a 14% year-on-year growth and 13% quarter-on-quarter increase. Our GP margins remain steady at 29%, showing a slight improvement compared to the same quarter last year and consistent with the previous quarter. In the month of September, the government has raised the import duty of palm oil by 20%. As you all know, from 5% the import duty has increased to 25%. To address this inflationary pressure and safeguarding our margins, we have implemented corrective measures in the month of September, which include reducing grammage in our 5 rupees price point and 10 rupees price point. And even in a couple of larger packs, we have revised the MRP as well, which have kind of nullified the impact of increase in raw material prices. Coming to EBITDA, for the quarter, we reported EBITDA at 47 crores, which reflects a 3% increase year-on-year and 14% increase quarter-on-quarter. EBITDA margin remained at 11.6%, down from 12.7% last year. While there has been an inflationary pressure because of increase in raw material prices for chana and palm oil and couple of other raw materials, but we have negated that by couple of our initiatives, which includes grammage reduction as well as some cost optimization measures. However, the slight decrease in the margin is on account of two reasons. One is the employee cost, which is increased due to the annual increment, and second is advertisement and promotion cost, where we have unveiled our Pistos campaign in Q2 of this year, which has resulted into a bit higher cost compared to Q2 of previous year. From a PAT perspective, we stood at 29 crores, showing 6% increase year-on-year and 19% increase quarter-on-quarter, and PAT margin remained at 7.2%. Now talking about H1 FY25 performance, for H1 FY25, we reported revenue from operation of 757 crores with year-on-year growth of 12%. Gross profit stood at 219 CR with a gross profit margin of 29%. Gross profit has witnessed a year-on-year growth of 8%. EBITDA on a cumulative 6-year basis, we reported at 88 crores with an EBITDA margin of 11.6% compared to 13.9% of last year. Coming to our balance sheet, we maintained one of our strongest balance sheet in the industry. Our ROC stand at 16.8%, which is when annualized it will be close to 33%. The H1 is simply multiplied by 2, and ROE is 12% on a half-year basis. However, annualized basis it will be more than 25%. Our asset turnover ratio for 6 months is 3.7 times, which is close to 7.5% on an annualized basis, reflecting the current capacity utilization of 36%. We see significant potential to further leverage this capacity as we scale up in the coming quarters. From a borrowing perspective, we have been very judicious in managing our cash flows. Our operating cash flow stood at 77 crores for H1,
which was utilized to repay working capital of 60 crores in the first half, and the remaining was allocated towards capital expenditure being incurred during the period. In summary, we remain well positioned to drive future growth while maintaining financial discipline. Our focus remains on optimizing operational efficiency, enhancing profitability, and delivering values to our shareholders. Thank you. That's from my side.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Navpreet Kaur from Summer Wealth. Please go ahead.
Good afternoon, sir.
Good afternoon.
Congratulations for good set of numbers, and thank you for giving me the opportunity. I have just two questions from my side. Firstly, could you share some insights on the company's growth strategy moving forward? Specifically, will the focus be on domestic expanding or growing export globally? Or additionally, within India, will the future growth be driven by core or focus markets, or are there any plans to explore new regions?
So, good afternoon, Navneet. This is Naveen Gupta. What I could understand, because there is little disturbance in the voice. So, your first question is about future growth strategy, right?
Yes, sir.
And second is whether we intend to go to the other regions as well, right?
Yes, sir. Yes.
So, coming to the growth strategy, we remain focused on three basic pillars which are required in the industry. One is, distribution. So, as Mukesh Bhai already shared that we have added more than 161 dealers, which is a strong 25% growth on our base in our distribution network. So we will remain focused on three basic parameters for the growth strategy. One is distribution network. We will keep expanding on our distribution network. Second is, around product. Whether it is product innovation, whether it is product renovation or product re-engineering. We have been working around all these parameters in product. We have been renovating many of our products, introducing new price points. Say, for example, in last quarter, we launched soya stick, which we can say is a national level product. We launched Sabudana Chivda, which is a regional product. We introduced 20 MRP price point, wafers and all. Product, there are multiple things which we are doing. And third is our marketing endeavor. We rolled out our Christos campaign in Q2, and results are clearly visible that our wafers growth are more than 40%. Now coming to your second question, whether we intend to go to the other regions. Yes, definitely we intend to go to the places which makes commercial sense to us. We may avoid going in general trade in Kerala or Tamil Nadu, but we are exploring anything and everything which is possible. Say, for example, we are ensuring our footprint on all e-commerce platforms in railways. Now we are present at Vendyman machines at Mumbai Airport, Delhi Airport, Bangalore Airport, all the major airports. We are ensuring that we are present at regional modern trade chains as well. So we intend to go to the other regions, but our primary focus will remain anything which is in the vicinity of 500 kilometers of our Nagpur factory will remain our preference.
Okay. And sir, my last question is regarding the capacity utilization. If I am correct, roughly 34% for Gatia and 28% for 19 and 11% for Wipro. Do you expect these levels to improve with the company growth? And any guidance for this year capacity utilization?
So what we could understand from your question is the product mix. What you are asking is saying is Gatia and Namkeen is something which is contributing 54% and wafers is contributing 11%. And is there a change? Yeah.
I
think your
asking about the.
Hello.
Actually, sir, I am asking about capacity utilization. Will it improve with the growth of the company?
Yes, capacity utilization is to improve. So there are two factors which impact capacity utilization. When we installed our capacity sometime 2, 3, 4 years back, our 5 rupees price point, we were offering close to 30-35 grammage of products. Now, over a period of years, this 30-35 grammage has come down to 20 grammage, 22 grammage. So almost 20% of the reduction in the material consumption has led to increase in the availability of the capacity, right? Another is for sure with the increase in revenue what we plan this year and going forward by FY27 we expect the capacity utilization will be close to 70%.
Thank you. The next question is from the line of Nitin Gupta from NK Global. Please go ahead.
Yeah, thanks for the opportunity. My question is again related to this capacity utilization. So, like for basin, we already reached 78% and wafers at 70%. So, just wanted to gauge on how we are looking to add capacity, or maybe we can shift line and can enhance the capacity for basin and wafers. That's my first question.
For wafers, we have already ordered 1500 kg per hour machine line, which is expected to get installed sometime in Q1 of next year. Currently, our utilization is close to 65%. Basin is something where we have a plan to have another basin plant somewhere in Nagpur, where we are working on cost benefit analysis, etc. So definitely with the increase in the growth, because the point is that basin is something where these materials are available from the market directly also. So while we are contemplating and will decide on whether we'll have a plant in Nagpur or not, but that's not a worry. Definitely for finished product like wafers, we have already ordered for a machine.
Yeah, thank you. And given we are expanding our footprint this quarter, we have added Odisha also. So any plans we have to sort of have some facility in the eastern part where we can cover the larger eastern region, plus we can also maintain the product freshness?
So we are open for any kind of M&A deals. Wherever the company gets value out of the acquisition, be it synergy benefit from production, distribution, etc. Even the eastern part of the country, definitely if we get some opportunity, we have visited a couple of plants and we are in process of doing due diligence, but still not very positive, but still the work is on. So we are open. Definitely whenever there is opportunity, we'll look for acquisition in any part of the country, especially eastern and southern where our footprints are less, we'll focus more there.
Can you repeat the last line? Eastern and southern preference is less, you have said.
Southern part of the country.
Okay. Next would be we have first time provided a slide for alternate channel. So can you throw some light in terms of what all actions we are taking here and how big is this channel particularly for this quarter and what is our aspiration here?
Nitin, hello, good afternoon. Naveen Gupta this side. So as far as alternate trade channels are concerned, our current run rate is 26 lakhs per month, right? So in absolute value terms or percentage terms, it's quite low number. But we entered into this channel 4-5 months back only. So today only we closed our negotiation with one of the largest e-commerce platform to have a national presence across their 20 DCs across India. and Reliance and DMart, we are in advanced stage of negotiations with them to increase our number of SKUs. We have now slight presence there with very limited SKUs, which was not earlier there. Right now, we are present at Amazon, Flipkart, and then Jumbo Tail, Big Basket, Zepto, Blinkit, and we closed our negotiation with this DMart Daily as well. The app wala. And 4-5 months back, we brought our presence to railways as well, and we got approval from IRCTC as well, because within railways there are two kinds of businesses which happen. One is through 9 railway zones, so you can be available at the platforms, and through IRCTC you can get inside the trains as well. So IRCTC approval we got a month back. So we expect all this business to be, roughly 3 crores plus per month by end of this financial year.
Thank you, Naveen ji. And lastly, just can you throw some light in terms of how is the profitability of these channels?
See, there are two kind of buyers in these alternate trade channels. One is like where we are giving to the consumer and using their platform. So that's a loss-making thing. However, quick commerce like Big Basket, Zepto, Blinkit, even DMart Daily, all these channels take stock from us on their DC. So wherever we are giving stocks at DC level, our profitability is either at par with general trade or rather little higher than general trade. And contribution of DC model channels is more than 80% in these alternate trade channels. As far as railways are concerned, so railways there is always provision of giving different grammages, different price points. So we make reasonable money there as well. None of these channels are loss making except couple of platforms where we don't go by the DC route.
Thank you. The next question is from the line of Sanjay Manyal from DAM Capital. Please go ahead.
Hi, sir. Specifically, I have question for this particular quarter. Our EBITDA margin has contracted during the quarter. You mentioned that it is largely because of the A&P spend. Can you quantify that? What kind of A&P spends we do, and is it specifically higher in this particular quarter?
Yeah. So overall, this quarter, as I said in Q2, we had this Christos campaign across Gujarat, where by our Christos campaign was available in all the leading OTT channels, and then a couple of hoardings in Rajkot, Ahmedabad, Baroda, even at airport site, etc. So we had, compared to last year, if I compare, last year we had close to 2 crores of A&P spent in Q2, which got increased to 5.5 crores. So there is 3 to 4 crores of increase which has come in marketing cost, and then there is a natural inflation which is because of the employee increment cost. So overall the margin has contracted because of these two costs.
So what is the sustainable level of A&P you want to do going forward?
So overall our estimate for FY25 is close to 1.5% of our revenue, which will be 18 to 20 crores this year. And going forward in FY26 also, we will have a higher, close to 25 crores of revenue, 2% of revenue being spent on advertisement and marketing.
Right. And sir, one last question on the specifically you mentioned that you are open for M&A for the geographical expansion. So if you are looking then in which area, which geography you have been looking for expansion specifically and for M&A in particular?
So we have a facility in Rajkot in Gujarat. We have facility in central India in Nagpur. We don't have facilities somewhere in eastern India, UP, in southern side, even in the northern side. So we are open for facility anywhere where our footprint is currently not available, because we wanted to grow at pan India, and the transportation costs, etc., play a very critical role in terms of margin availability in making the product available at the right time to the customers. So we are exploring acquisition across all these locations, and we are open there.
Thank you. The next question is from the line of Abneesh Roy from Nuvama. Please go ahead.
Yeah, thanks. My first question is on the category growth in your states, areas of operation. Is it also similar to the 12-13% growth? And are you gaining some share of wallet from, say, noodles, etc., in terms of snacks? Because now in many areas, noodles is about 10 rupee pack. So do you see that as an opportunity? And speaking about the national players, I know that at 10 rupee there are regional noodles brands, but the good growth which the category is getting, the snacks category of yours is getting, is it because you are gaining share from noodles, etc.?
Noodles, see, largely in 5 rupees price point, it's regional player. I mean, they sell at cutthroat pricing, and with increase of palm oil pricing, it will become unsustainable for those regional players as well. As far as 10 rupees price, our snacks, our namkeen growths, में noodles का contribution is significant in terms of growth. Our Gathia has primarily grown by 13.4%, which is a 15.7% in terms of volume and 13.4% in terms of value. So Gathia has significantly contributed to our salty snacks category growth, and wafers has 40% growth in volume and 46% growth in revenue in value terms. Noodles is a sort of wherever we can take advantage of our distribution strength, we are trying to sell there. We are trying to sell at margins. We are not selling at discount.
No, my question was different. My question was two, essentially. One is your growth, say in Gathia or say in wafers. What is the market growth rate in your areas of operation? Second, I was not asking on your noodles. I was asking from a consumer preference perspective, is noodles losing share? I know you have a small presence in noodles. I was not asking on your presence. I was asking on the market leaders' slow growth in noodles. Is it because customer is shifting towards bhujia, wafers, etc.?
Consumer behavior is changing so fast. It's really difficult to measure whether consumer of noodles is shifting to snacks and salted snacks category. Typically, what happens in summer vacations, consumption of noodles goes up when children are at home. And when school time starts, so every snack which is ready to consume, its consumption goes up. And as far as growth of salty snacks category, other players or industry growths are concerned, since we are the market leader in Gathia and all other players, I mean, there is no major brand as such who can proclaim to be number 2 or number 3 in Gathia. So their numbers are not available, whether who is going at what pace in Gathia.
Okay, understood. Second is, in the opening remarks you mentioned on the vending machine in airports and the IRCTC. These will be mostly marketing initiatives, because I think here there is a lot of visibility which you also get, especially vending machine. Do you make money in this part of the business?
Vending machine business, yes, we are making money. Even after spending on marketing, net we are making money. And railway products, definitely we are making money at par with our general trade market.
Okay. That's all from my side. Thank you.
Thank you. The next question is from the line of Reshma Mehta from Green Edge Wealth. Please go ahead.
Yeah, thank you. It's very sharp. So the first one is on the distribution. So it's possible to keep adding distributors at, say to the tune of 80 distributors per quarter. So do we see this kind of aggressive run rate continuing, let's say, for the next 1-2 years? And also, a large part of these distributors, are they being specifically added to the focus markets, or are we seeing a more uniform kind of expansion across our states? So this is the first question.
Okay. So hello, Risha. Naveen this side. Risha, coming to your first question, whether it is something sustainable that we keep adding 80 distributors every quarter, right?
Right.
So we intend to have footprint at tehsil level or taluka level within 400 to 500 kilometers vicinity of our Nagpur facility. So that means by end of this financial year, we'll have more than 1,000 distributors, and we will continue to add, one distributor per working day in next financial year as well. And there is humongous scope. Right now we have 170 distributors in rest of Maharashtra. So if we just take Vidarbha regions, there's a scope of adding another 30-40 distributors within Vidarbha itself. Then Marathwada, we can add roughly 60 more distributors. So number of distributors will keep growing. Right now, the size of newer distributor is small, but how the business will happen that these small distributors will, keep becoming bigger, and then we'll keep adding the smaller distributors. And as far as this footprint is concerned, whether this will be confined to focus markets or specific markets, adding more number of distributors in Gujarat will never be at pace of what the other markets will have. Gujarat, we have a different strategy that we will keep splitting our existing distributor to create more distribution points, so that wherever distributor have challenge of putting more money or infra, so we'll have more number of distributors definitely in Gujarat as well. But pace of making newer distributor in other states will be 4x or 5x versus Gujarat.
Right. And also, one related question is that a lot of the new distributors that you have added, some of them are also new to category distributors. So are you seeing any divergence on, let's say the performance of these new to category distributors versus, let's say, you all having added a distributor which was already which is already selling this category or familiar with this category? Are the throughputs any materially different from these distributors?
We do not make a single distributor, Resha, who already sells a competitive product. However, anybody who is selling, say, biscuits or cold drinks or confectionery or rusk or bakery, so we add those kind of distributors.
Thank you.
So no existing distributor can sell the same product.
Thank you. The next question is from the line of Sukant Garg from Equable Research. Please go ahead.
Hi. So my core question is regarding the trade payables and inventory. If I see the presentation that you've published, in that trade payables and inventories have been steeply down from March FY24 to H1 FY25. And my second question is on PBT and EBITDA. Why PBT and EBITDA is degrowing while the gross margins have been maintaining? Is there any kind of inefficiencies in below the line products, below the gross margin expense accounts?
So your first question is on the working capital, where you mentioned about the trade payable is increasing, right?
Decreasing. Trade payables and inventories have been decreased usually.
No. If you go through the slide, the inventory in fact has increased. If you refer the slide, inventory in terms of number of working days has increased, which used to be 42 days in FY23 has increased to 64 days in FY25, H1 of FY25. And the debtors and creditors is more or less similar at 6 days and 5 days. So why the inventory has increased?
Sorry, please. Sorry. Yeah, please.
Inventory days has increased is because in the initial part of the year, in Q4 and Q1, we have procurement of crops. Whenever there is a crop season, we do procure chana, potato, and store for 7 to 8 months of the consumption. So initial first 2 quarters, you'll see increased days of holding of inventory, and over a period of time, as the years progress, the inventory number of days comes down. In terms of creditors and debtors, it is more or less uniform in all the 4 years. This is the slide. If you are referring to our earning deck, it is at page number 23.
So I am referring to the slide number 22, in which the inventory the trade payables came down from 20.9 crores to 8.3 crores from FY24 to H1 FY25.
Well, it's something where we make payment to vendors. So 8.3 is so there is no outstanding at that point of time. Maximum payment has been carried out. We hardly have trade payable. It is close to 2 to 3 days of our creditors. So we are healthy in terms of quick payment to our vendors. So it has come down from 21 days to 8.3, right? So there is no science as such. It is something where our credit pay to the vendors is within 7 days. We try to make payment to our vendors.
Thank you. The next question is from the line of Palak from MIV Investment Management. Please go ahead.
Hi, sir. So I have a couple of questions. My first question is regarding the competitive intensity that we experience in the state of Gujarat. So, and is the major part of the advertisement expense was for the focus state, or was it for the core and focus state? The second question is that this quarter we saw that the focus state grew by 30%. So do you think that this kind of growth is possible for the next 2-3 years? Or you can share the expected growth that you see in the core and the focus market for this year and let's say next 2 to 3 years.
Okay. So Palak, your first question is around competition intensity, right?
Yeah.
So in our core markets, in wafer segment, we have been growing at more than 40%. So competition intensity is there. But if competition is trying to eat our market share in our category, we are eating their market share in their category. So as you know that before these 2 quarters, earlier 2 years, we had flat growth in our core state. Now, whatever corrections we had to take, we did in Q1 in this financial year. Now we are in growth trajectory and we have ample strategies in place how to not only protect our market share, rather take market share from the competition as well in core state. So that will be around, our marketing endeavor, whatever advertisement spends we did, were completely focused on our core state. We didn't go to our focus states even with our marketing spends. Now coming to your next question, that focus states, which are our 4 focus states like Maharashtra, UP, Rajasthan and MP. So we have grown there by 30%. So whether this kind of growth is sustainable or not. I previously answered probably to Resha's question that we intend to add 1 distributor per working day, at least for next 500 days. So we will keep getting organic growth through our existing product growth plus addition of new products plus inorganic growth through addition of newer distributors. So this kind of growth is definitely sustainable in focus states as well as other states.
Thank you. The next question is from the line of Shreya Srinivas from Bain Capital. Please go ahead.
Hi, good afternoon. So you said your EBITDA margin was down slightly from last year, and you said it's driven by broadly your employee cost and marketing spends. और आपने ये भी बोला था कि essentially what you did is because raw materials went up, you implemented some corrective measures by reducing grammage in rupees 5, rupees 10, and then revising your MRP in larger packs. Now the question that I have is, how quick were you to implement this reduction in grammage and pass it on to the consumer? And B, do you expect raw material prices to cool down in the coming quarters, or if not, when do you expect them to start cooling down or correcting?
So I'll take your first question. The grammage correction, etc., it is a very quick implementation time for us because it is all digitally maintained in terms of the grammage, the grammage of raw material to put it into the SKU. So it is something where when we take a call, it can be implemented the next day.
Got it.
So it's in terms of your next question, which was on, can you repeat your next question?
The next question was around raw material prices. So raw material prices, like you said, have increased over the last few quarters. Now the question is, if you look at all of the key raw materials, especially for namkeens, all of them have gone up in FY25 versus 24. The question is, when do you see them correcting over time?
So Q4 is the quarter where again the crop of chana will come, and looking at a favorable monsoon which we see last month, I think Q4 is a time where we'll see the ease in the raw material prices, specifically in chana and potato. Palm oil is something which is because of increase in the import duty, which government has imposed sometime in September. So to wait and see, I see there has been ample supply of palm oil in Malaysia, etc. But because of the duty, incremental duty which has come, the price there is an increase in the price of palm oil. This is something we have to wait and see. But I think Q4 is a time where again the revision in import duty is expected. Is what my guess. So Q4 will be the time where the raw material prices again is going to get ease off. Yeah, Naveen wants to add.
Sorry, go ahead.
I would like to rather add one point to this. Typically in our industry, a brand like us or company like us is okay with RM prices high because it gives us opportunity to take market share from unorganized players. So whenever palm oil prices, edible oil prices are like this, so that helps us to gain market share from unorganized players.
Correct.
It's okay with us.
Understood. Okay. Another question I had is, sorry, can you just repeat what was the import duty on palm oil before and what it did go to now?
5% has gone to 25% in September.
Got it. Okay. Understood. Helpful. Thank you.
Thank you. The next question is from the line of Saloni Jain from Nirmal Bang PMS. Please go ahead.
Hello, sir. Am I audible?
Ma'am, I would request you to please use your handset.
Hello?
Yes, ma'am. Please go ahead.
That's better now.
All right. So my first question is on your plans to expand exports since they are only 0.2% of our sales this quarter. And what kind of traction can we see in Indian ethnic snacks in our export markets?
You're Saloni, right?
Yeah.
So we are in process of, we're doing a lot of correction in our product basket in terms of grammage, in terms of design, in terms of key line dimension, etc. Export remains on our radar, but we have so many other low-hanging fruits that we purposely deferred our export focus for Q1 next financial year. Because for that, right now our approach will be to go through some sort of unconventional arrangement. Say, for example, we met a guy in Mumbai who is doing roughly 3 crores, 4 crores chicky ka export, right? So he has some export base. So right now we go through this unconventional route that we will use some other platform to maintain our run rate in exports. But our focus in export will start coming from Q1 next financial year.
Okay, sir. And so my next question is, so you mentioned that we are expecting 70% capacity utilization by FY27. So at this capacity, what is the peak revenue that we can expect, and what would be the sustainable margins here after operating leverage is also playing out?
FY27, by end of FY27, we are expecting revenue to be in the range of 2,150 crore to 2,200 crores. And our EBITDA margin will be in the range of 14 to 14.5%.
Thank you. The next question is from the line of Ashok Shah from Elara Securities. Please go ahead.
Thanks for taking my question. Sir, are we doing something for the Diwali season? Something like sweets or something we are planning to launch?
No, Ashok bhai, don't intend to come out with sweets category at least this financial year. It needs a lot of preparation, and the preparation has to start from the month of April if we have to do something in Diwali. We are not doing anything in sweets category for Diwali.
Thank you. That's all from my side. Thank you.
Thank you. The next question is from the line of Rishi Kothari from PI Square Investments. Please go ahead.
Hi, thank you so much for the opportunity and congratulations on good set of numbers. So I was going through the quarterly results, and quarter-on-quarter growth is actually very promising for the company. It seems like the company is on revival after 2 years of muted growth and all. So what type of quarterly growth we are expecting, let's say 2-3 years quarter down the line? So right now we see a top line of 13-14% and PAT of 20-21% odds. So what are the targets for next 2 to 3 quarters in terms of growth?
This financial year, Rishi, we will, on annualized basis, our growth rate will be more than 14%.
More than 14%.
14%. So we can easily do a reverse calculation. Q1 we grew by 11.2%. Q2 we grew by 12.6%. So definitely we have a clear plan in our hand that we grow by 14% in Q3 and 16% in Q4. So that will translate into an annualized growth of 14% plus. Now next financial year, we intend to do our A&M spends by 2%, and whatever investment this financial year we are doing either in people or in products, that will start yielding us good results right from Q1 next financial year. So next financial year we intend to have a growth of 18 to 20%.
18 to 20%. Okay, makes sense. And we do have the similar target of 2,150 to 2,200 crores of top line by FY27.
We have to deliver that because since there was no growth in last 2 financial years, so I mean that made our base flat. So I mean we have to plan that kind of growth. So everything, every platform which is required to deliver that kind of growth, we are working on each of the platforms.
Thank you. The next question is from the line of Dharmil Shah from Dalmas Capital Management. Please go ahead.
Hi sir. Thank you for taking my questions. So first question is more on the distribution side. So I mean, Gopal has already added 80 distributors last year and 160 distributors in the current year, which is almost 30 to 35% on the base of last year. So in context of this, I mean, I just wanted to understand why is the revenue growth is lower at 14% or 18%, and how much time does a new distributor take to get to a point where he is contributing to a level where a mature distributor is right now?
Yeah, hello Dharmil. See, there are 2 things. One, on weighted average contribution terms, Gujarat was contributing more than 71% in last financial year, right? The contribution from Gujarat as such has come down by 5-6 BPS. So if you see, revenue growth has largely come from focus states. So initially, every new distributor, there's a ladder which gets created. Every new distributor starts from basic working capital of 1.5 lakh, 2 lakhs. And then it takes him 3 months to 6 months to move to an average business of 3 lakhs. After 5 lakhs per month business, his break-even starts coming. And this is how the ladder start getting building up. So precisely when we talk about 18%, 20% kind of growth next financial year, so everything which we are working right now, whether it is product, whether it is distribution, whether it is marketing endeavor, so all these three things will start giving its own result. The distribution platform which we are building right now, its reflection in revenue will start actually coming in Q4 and then Q1 onwards.
Understood. But broadly, if I see the current number of distributors, broadly we get around 2 crore per distributor as a run rate for the entire year. So how much time does a new distributor take to reach to that level? I mean, in terms of years, is it within 1 or 2 years, or it takes slightly longer time?
I mean, it definitely takes. You mean to say 2 crores per annum means 18 lakh rupees per month, right?
So this is valid for Gujarat, where you see average revenue from dealer is more than close to 2 crore on an year. But when it comes to outside Gujarat state, the numbers is slightly lower. And it takes the break-even point is something what Naveen ji said, it is 3 to 6 months once the dealer is onboarded. And then there are a lot of efforts which we have to put in terms of increasing the range selling, upselling to a various retail touch point, increasing the retailers at a distributor end. So it takes close to one.
Let me put it like this. Rajasthan, our run rate was 2.5 crores. Number of dealers were 27. I'm talking 6 months back. Right now we have 54 distributors and our run rate is 3.25 crores. So we can say number of distributors have doubled, but the turnover has gone up just by 35% in Rajasthan. So that clearly shows that newer distributors' average revenue contribution is roughly 2.5 lakhs only. Now, contrary to that, if I go to Chhattisgarh, my number of distributors were say 35, and my value business was just 70 lakhs. My number of distributors in Chhattisgarh, अभी कितना latest 28. So earlier it was 24. So it has come to 28, whereas revenue has gone up from 70 lakhs to 2 crores per month. And very good signs in a state like Chhattisgarh, 52% contribution is coming from larger packs in Chhattisgarh. So it will differ from place to place, but generally it takes 3 to 6 months to come to a break-even point to a new dealer, and for coming to a level of 2 crores per annum, it may take 2 years to 3 years.
Thank you. The next question is from the line of Naman from RV Investments. Please go ahead.
Hello.
Mr. Naman?
Yeah, Naman.
Hello, sir.
Hello.
So my question is on the market outlook. How do you expect the market to go from here?
Market outlook is, Naman, very positive for us. We will grow in our existing product with our existing product baskets as well. We will keep introducing newer products in line with urbanization trend. The way consumer behavior is changing in terms of consumption. Similarly, buying patterns are also changing. So market outlook is quite positive. Indian consumption story remains intact. Per capita income is going up, so per capita consumption will also keep going up. Earlier, frequency of consumption of meals was say thrice in a day. Now people have meals thrice in a day, and then in between snacks probably 3 times in a day. So still India's per capita consumption of snacks is just 35 to 40% of developed countries. So market outlook is quite positive.
Okay, thank you, sir.
Thank you. The next question is from the line of Yash from Stallion Assets. Please go ahead.
Hi, thank you for the opportunity. So I just wanted to understand that we've seen good volume growth across all Gatia, namkeen, wafers, but for pellets and extruded snacks, I see there's a 5% degrowth, on a half-year basis. So what has happened on this category?
Yeah, I was wondering that nobody asked this question from me. Yes, see, we know the reason why we have declined in snack pellets, and we already have action plan, and we have initiated that action plan. Let me give you a glimpse of what two action plans we have just initiated. We were selling in a strip size of 8 pieces in a strip, unlike competition who was selling 12 pieces in a strip. So we have already done a course correction, whereas in 50% of our snack pellet items in first week of October we started selling in 12 pieces strip. So that will increase our depth at an outlet. And the second one is our snack pellets are typically traditional snack pellets like ponga, katori, etc. So I will not disclose name of the product, but we will introduce a very upmarket kind of snack pellet within next 15 to 20 days. So that is targeted at the urban consumer. Price point will remain 5 rupees, 10 rupees only. But the product is upmarket product. So the snack pellet category also you will see in positive greener numbers in next quarter as well as in this H2.
Thank you. The next question is from the line of Bhumin Shah from Sameeksha Capital. Please go ahead.
Hi, sir. Good afternoon. So can you provide the breakup of wafer sales in core market and focus market out of 45 crores?
So, hi, Bhumin. So if we have to break up in terms of core market and focus market, overall revenue is close to, so from core market it is 21 crores, 22 crores, and from the focus market, the number is, just a second, it's 18 crores. So 21 plus 18. And,
okay,
and the balance is from outside market.
Okay, so where we are seeing the more traction, in the core market or the focus market? Because in core market there is a one leader which is having around majority market share, where in focus market it will be a same player.
So growth is there in all the markets for wafer segment, but the maximum growth is, in terms of percentage growth, if I say, the growth has come from the focus market.
Okay, and one more question is regarding the EBITDA margin. So we have already spent around 5 crore this quarter on advertising and promotion, and we are planning to spend more, another 10 crore for next 2 quarters. So what would be the EBITDA margin like? It will remain in around 11.67, or we can see the operating leverage playing out over here?
So my estimate is that it will be a bit higher than Q2, maybe in the range of 12%, provided the raw material prices, etc., remain in the current range. We will get to a 12% margin in Q3.
Okay, that's it from my side. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Dharmal Shah from Dalmas Capital Management. Please go ahead.
Hi, sir. Like you mentioned, for pellets and extruded snacks, namkeen products as well has been growing slightly at lower rate. So, any reason why the growth is lower?
Namkeen segment, compared to Gatia, it is little lower.
Yeah.
So, Namkeen, we understand